Hey everyone, and welcome back to the channel. Let's cut right to the chase. The market has been buzzing, the whispers have turned into shouts, and the writing is on the wall. In big flashing neon letters, the Federal Reserve is going to cut rates in September. Now, for weeks, it's felt like we've all been watching a slow-motion movie, waiting for that one final clue to drop. And on the 29th of August, we got it. The PCE inflation report landed, and it was perfectly fine. A total nothing burger. It came in right where everyone expected, and ironically, that beautiful, boring, no surprises here report was the final green light. But here's the thing, that report isn't the real story, it was just the excuse. The real reason the Fed is about to hit the dovish button is hiding in plain sight, in a place that's starting to look a lot more fragile than the headline numbers suggest. Today, we're going to pull back the curtain. We're not just talking about if they'll cut that's practically a done deal. We're talking about the deep structural reasons why. We'll look at the bombshells hiding in the jobs data, the massive, game-changing rule change the Fed just gave itself, and what the big money is already doing to prepare. Stick around, because this is the playbook for the next quarter. So first, let's talk about that catalyst. The Personal Consumption Expenditures Report, or PCE. This is the Fed's favorite way to measure inflation, their holy grail of data. And the numbers for July were meh. Core PCE, which strips out the wild stuff like food and gas, ticked up to 2.9% year over year. Still stubbornly high, still way above the Fed's 2% target. In a normal world, a 2.9% reading would have the hawks circling. People would be screaming, "See, inflation isn't dead, no cuts for you." But we're not in a normal world, are we? The market's reaction was to increase the odds of a September cut. So, what gives? This is where you have to appreciate the genius, or perhaps the sheer narrative control, of Fed Chair Jerome Powell. Just a week before that PCE data dropped, he stood up at the Jackson Hole Summit, the big annual party for central bankers in the mountains, and basically handed the market a new playbook. He didn't just give a speech, he laid down a filter for how to read all future data. The key phrases were pure gold for the doves. He said, and I quote, "Downside risks to employment are rising." He talked about the labor market being in a peculiar balance. And then the money shot. The shifting balance of risks may warrant adjusting our policy stance. Translation from Fed speak to English. We're worried about jobs and we're ready to cut. He preemptively told the market, hey guys, we know inflation is still a little hot, but our main focus has shifted. We're looking over here now at the job market. So when the PCE report came in, as expected, it didn't matter that it was high. What mattered is that it wasn't shockingly high. It didn't provide a new reason for the Fed to panic about inflation, which effectively cleared the last hurdle. The non-event became the main event, allowing everyone to focus on the one thing Powell wanted them to focus on. The American job market is sputtering. And this, my friends, is where the story gets juicy. The real, number one, top-of-the-charts reason for this policy pivot isn't inflation. It's the undeniable, unavoidable, and frankly alarming slowdown in the U.S. labor market. The evidence is a three-act tragedy. Act 1, the headline flop. The July non-farm payrolls report was a dud. Only 73,000 jobs were added. That's barely enough to keep up with population growth. It's a stall. Hiring has basically flatlined. Act 2, the revision horror show. This is the real kicker. Sometimes the most important news is buried in the footnotes. The government didn't just release the July numbers, they also revised the numbers for the two previous months, May and June. And holy cow, they wiped out a combined 258,000 jobs from the previous reports. Let that sink in. The job market we thought was chugging along nicely through the spring, turns out it was basically running on fumes. The 3-month average for job creation plummeted to a pathetic 35,000. Historically, that's a number you see right before the flashing red lights of a recession start going off. Act 3, the coming bombshell. If you think that's bad, just wait. On the 9th of September, the Bureau of Labor Statistics is set to release its preliminary annual benchmark revision. This is when they true up their monthly survey data with more comprehensive, hardcore tax records, and the forecasts are grim. Some analysts are predicting this revision could erase as many as 775,000 jobs from the count over the past year. That would mean the job market was way weaker for way longer than we ever knew. Now, you'll hear people say, but the unemployment rate is only 4.2%. That's historically low. And they're right. But the unemployment rate is a lagging indicator. It's the last thing to break. The Fed is looking at the flow, not the level, and the flow of new jobs has dried up. They are acting now as a form of insurance. They're not waiting for mass layoffs to begin. They're responding to the fact that the hiring signs have been taken down all over the country. This is a preemptive strike, and it's all about the jobs. So, the jobs data is screaming for a cut. But for the longest time, the Fed had a self-imposed problem. A set of rules they wrote back in 2020 called Flexible Average Inflation Targeting, or FAIT. This is going to get a little nerdy, but it's absolutely critical to understanding why September is a lock. Under FAIT, the Fed promised that after a period of low inflation, they would let inflation run hot for a while to make up for it and get the long-term average back to 2%. Well, we got the hot part in spades. The problem is, to stick to their own rule, after years of high inflation, they should technically be aiming for a period of below 2% inflation to bring the average back down. That would mean keeping policy tight, not cutting. It was a hawkish straitjacket of their own design. It was a framework built for a world of perpetually low inflation, and it was completely useless, even dangerous, in the post-pandemic world. So, what did Powell do at Jackson Hole? He threw it in the trash. They officially announced a shift back to a simpler, flexible inflation targeting, or FIT. The key difference? They got rid of the average part. In this new framework, they're essentially saying bygones be bygones. They no longer have to punish the economy today for the high inflation of yesterday. It unshackles them. It gives them the policy justification, the intellectual cover to cut rates even with inflation near 3%. Under FIT, the logic is simple and forward-looking. Are there risks to the job market? Yes. Are we confident inflation is on a path back to 2% eventually? Yes. Okay, then. We can cut under the old FAIT system. A cut would have been a logical pretzel. Under the new FAIT system, it's just common sense. This wasn't just a minor tweak, it was a strategic reset that gave the FOMC the green light it needed. Now, there are a couple of other things people point to as reasons the Fed should stay on hold, but the Fed has already told us they see right through them. First, tariffs. There's been a lot of talk that new tariffs will push up prices, but the consensus view inside the Fed, from Powell to San Francisco Fed President Mary Daly, is that this is a one-time shock. It's a one-off level shift in prices, not a sustained ongoing inflationary spiral. Think of it like this. If the price of coffee beans goes up, your latte gets more expensive once. It doesn't mean it's going to get more expensive every single month after that. The Fed can look through this kind of inflation. Second, that beefy Q2 GDP number. The headline read 3.3% annualized growth, which sounds fantastic, but if you pop the hood on that number, it's a bit of a mirage. A huge chunk of that growth came from a massive drop in imports. Why did imports fall? Because businesses front-loaded all their orders in Q1 to get ahead of the tariffs. A much better gauge of the real domestic economy, something called real private domestic final sales, grew at a much more sluggish 1.9%. That tells you the core momentum of the U.S. Private sector is already fading. So, when you put it all together, a weak jobs report, horrific downward revisions, a new policy framework that allows for cuts, and a clear signal they're ignoring tariff and GDP noise. The case for a September cut isn't just strong, it's overwhelming. The best part is, you don't have to take my word for it. Just look at the markets. All the major asset classes are screaming the same thing. They're already pricing this in. The bond market. This is the smartest kid in the class when it to Fed policy. The 2-year Treasury yield, which is super sensitive to what the Fed is about to do, plunged by 33 basis points in August. That's a massive move. This is what's known as a bull steepener. Short-term rates are falling way faster than long-term rates. It's the classic signal that the market is aggressively pricing in imminent rate cuts, believing the Fed will act decisively to save the economy from a worse downturn. This one's simple. When a country is about to cut its interest rates, its currency becomes less attractive. Money flows to where it can get a better return. Unsurprisingly, the US and Dow. Dollar index DXY got hammered in August, falling over 2.2%. It's a textbook reaction. Lower rate expectations mean a weaker dollar. The stock market. Now, stocks are the interesting, schizophrenic ones here. The S&P 500 and the Dow actually hit new all-time highs in August, but they couldn't hold on to them. We saw a pullback at the end of the month, especially in the high-flying tech and AI names. This is the classic good news is bad news dilemma. On one hand, lower rates are like rocket fuel for stock valuations. Yay! But on the other hand, the reason for the lower rates, a rapidly slowing economy, is terrifying for corporate profits. Boo! The market rally was the sugar high from the prospect of Fed cuts. The pullback was the market starting to sober up and realize, oh wait, this means earnings might be about to get ugly. And then there's gold. The shiny metal had a monster month, up almost 4.8%. It was the perfect storm. First, as bond yields fall, the opportunity cost of holding a zero-yield asset like gold goes down, making it more attractive. Second, the weaker dollar makes gold cheaper for foreign buyers. And third, with all this talk of a slowing economy, investors flock to gold as the ultimate safe haven asset. Gold is absolutely loving this setup. The base case is crystal clear. The Fed will cut rates by 25 basis points, 0.25%, at its September meeting. It's not a panic 50-point cut, because the jobs market isn't in a total freefall just yet. It's an insurance cut, a calibrated, deliberate first step in a new easing cycle. So here's a potential multi-asset strategy to consider. On bonds, an easing cycle is a green light to add duration. This means looking at longer-term U.S. Treasuries to capture the price appreciation as yields fall further. Stick to high-quality, investment-grade corporate bonds. This isn't the time to be a hero in the junk bond market. On stocks, it's time to play defense and focus on quality. A slowing economy is bad news for cyclical sectors. Think about rotating into more stable, non-cyclical areas like healthcare, utilities, and consumer staples. Look for companies with fortress balance sheets, strong cash flow, and low debt. On currencies, the path of least resistance for the dollar is down. As the Fed cuts, while other central banks might stand pat, the interest rate differential will continue to work against the greenback. A short dollar position could be a core macro play. On commodities, gold remains the star of the show. Falling real yields, a weaker dollar, and its role as a hedge against economic uncertainty create a powerful trifecta of tailwinds. It's a key portfolio diversifier in this environment. Of course, there are risks. A shockingly strong August jobs report or a surprise spike in inflation could throw a wrench in the works and cause a violent market reversal. But given the mountain of evidence, the downward momentum in the data, and the Fed's very public pivot, that seems like a long shot. The Fed has built its case, telegraphed its move, and even changed its own rules to make it happen. The September cut is coming. The only question now is whether it will be enough. Thanks for watching. If you got value out of this breakdown, hit that like button, subscribe to the channel, and let me know your thoughts in the comments below. Until next time.